If you woke up this morning, checked your portfolio, and felt that familiar sinking feeling in your stomach, that, here we go again, dread, I need you to stop scrolling for a minute. Take a breath, because what happened last night wasn't a market crash. It was something way more interesting. And by the end of this video, you're going to understand exactly what they did, why they did it, and most importantly, why you have more power in this situation than you think. Let me tell you what happened. While New York was dark and London was just pouring its morning coffee, the CME Group, the exchange that controls silver futures trading, raised margin requirements by 50%. Now, if you don't know what that means, don't worry. Most people don't, and that's absolutely by design. The system thrives on your confusion, but we're going to fix that right now. Here's the simple version. Imagine you're at a poker table. You've got $1,000 in chips in front of you, and you're playing your hand. Suddenly, mid-game, the house announces that the minimum buy-in is now $1,500. You've got exactly 1 hour to come up with $500 more, or they're going to cash you out. It's 2 a.m. Where are you going to get $500 at 2 a.m.? You can't. So the house takes your chips and kicks you out of the game. That's what a margin hike does to futures traders. See, most people think the price of silver is determined by two people swapping physical coins. It's not. It's determined by speculators trading futures contracts on exchanges like the COMEX. These contracts are highly leveraged, meaning traders are using borrowed money. Until yesterday, if you wanted to control 5,000 ounces of silver worth about $300,000, you didn't need 300,000. You only needed a performance bond called margin of about $12,000. That's 25-to-1 leverage. This leverage allows hedge funds, day traders, and algorithms to bet massive amounts of money with very little cash down. But here's the thing. That leverage is also a kill switch that the exchange controls. Last night, they pulled that switch. They raised that margin requirement. Let's say they went from $12,000 to $18,000 per contract. That doesn't sound like much, right? But imagine you're a hedge fund holding 1,000 contracts. Yesterday, you needed $12 million in cash on deposit. Today, at 2 a.m, the exchange says you now need $18 million. You have 1 hour to wire $6 million, or we automatically sell your position. Where do you get $6 million at 2 a.m.? You don't. So the exchange's computer automatically sells your silver contracts at whatever the market price is to cover the difference. This creates a wave of artificial selling. It's not because the fund wanted to sell. It's not because the fundamentals changed. It's because the house changed the buy-in mid-game. This is what I call the margin nuke. It's designed to flush out the weak hands, the speculators who are over-leveraged. When they sell, the price drops. When the price drops, other people panic and sell. It triggers a cascade. That was the plan, but here's what they didn't expect. Here's the news that should terrify JP Morgan and delight every single person holding physical metal. It didn't work. In 2011, when they did this exact same thing, the price collapsed 30% in a week. In 1980, when they did this, the price collapsed 50%. Today, the price flinched. It dipped, and then it stood its ground. We dropped less than 1% and bounced right back to $64. Let me tell you why this failed manipulation actually proves you're on the right side of history. The fact that the margin nuke didn't work means the game has fundamentally changed. The old playbook where paper contracts controlled the price is breaking down in real time. And here's why. The people buying silver in 2025 aren't gamblers using 25-to-1 leverage. They're industrial manufacturers who need silver for solar panels and electronics. They're sovereign nations stockpiling real assets. They're regular people like you who are paying cash for physical metal. When you own physical silver, margin hikes don't affect you. You can't get liquidated. You can't get margin called at 2 a.m. You just own it. It sits in your safe. The exchange can change whatever rules they want on their casino floor, but they can't reach into your house and take your metal. The banks bet you would panic when you saw that red candle. You didn't. That's power. That's real power. Now let me take you back in time, because if you don't understand history, today's red candle is going to scare you out of your position. The date was Sunday, May 1st, 2011. Osama bin Laden had just been killed. The news cycle was chaotic. Silver had just touched 49.50. It was a parabolic run. Everyone was euphoric. Then, under the cover of darkness and distraction, the CME Group announced a margin hike. They raised the maintenance margin by 13%. On Monday, silver dropped $5. The next day, they raised margins again. On Wednesday, they raised them again. By Friday, they had raised margins 5 separate times in 9 days. They beat the market into submission. They forced the liquidation of billions of dollars of long positions, and it worked. The price crashed from 49% down to $33, and it entered a bear market that lasted for years. The banks are relying on your muscle memory of that event. They want you to look at today's chart, remember 2011, and think the party's over. I need to sell before it crashes. They are weaponizing your trauma. They're counting on you to be scared, but look closer at the chart today. In 2011, the drop was violent. It was 10% in a single day. Today, we're down less than 1%. We're consolidating at a higher level. Why the difference? In 2011, the rally was driven by paper demand. It was driven by hedge funds buying futures contracts and SLV options. There was no shortage of physical metal in 2011. The vaults were full. When they killed the paper demand with margin hikes, the price collapsed because there was no real physical shortage supporting it. But in 2025, the rally is driven by physical depletion. We have a 1.1 billion ounce supply deficit. The vaults are empty. Refineries are halted because they don't have material to process. You can raise margins on paper contracts all you want. It doesn't create physical metal. It doesn't help Samsung build solar panels. It doesn't put silver back into the LBMA vault in London. The margin nuke is a paper weapon used to fight a paper war. But we are in a physical war now, and you cannot bomb a physical shortage with paper regulations. The fact that the market absorbed this blow today is the most bullish signal I have ever seen. It tells me that the paper market has become irrelevant. The physical market looked at the margin hike, shrugged, and kept buying. Right now, there's a psychological game being played, and this is where you need to stay sharp. Think about the average retail trader today. He wakes up, sees the news that the exchange raised margins. He sees the price dip below $64. He thinks the top is in. The government is stepping in. I better sell now. Maybe he'll even short the market to make money on the way down. So Joe sells his silver. Maybe he even places a short bet, betting it will crash to $50. But who's on the other side of that trade? Who bought Joe's silver at $63.80? Was it another retail trader? No. Retail traders panic on red days. It was an algorithm. It was an industrial buyer. It was a sovereign wealth fund. They sat there with their limit buy orders, waiting for the margin nuke to shake the tree. They knew the weak hands would fall out, and they stood underneath with a bucket to catch the cheap shares. This is called a bear trap. The price gets pushed down to trick you into selling, then it reverses aggressively and traps the people who went short. Now the market has cleared out the weak, leveraged speculators. The ownership is transferred from paper hands to diamond hands. The people holding silver tonight are not the people who panic over a margin hike. They are the people who hold for the long term. This makes the price floor rock solid. And what happens to Joe, who went short when the price turns around on Monday? When it gaps up to $65 or $66, Joe is trapped. He has to buy back his short position at a loss. His buying adds fuel to the fire. The margin nuke didn't kill the rally. It reloaded the cannon. It cleared out the leverage so the next leg up can be sustainable. We are building a base at these levels, And a base built on physical demand is infinitely stronger than a spike built on paper speculation. This brings us to the weekend, and this is critical. Why are the banks fighting so hard to keep the price down today, specifically on Friday? Because they are terrified of the weekend. In a globalized market, the weekend is when Western suppression turns off and Eastern reality takes over. The COMEX closes on Friday afternoon. For 48 hours, the paper manipulators cannot touch the price. But the world doesn't stop. News happens, deals happen, and the Middle East and Asian markets open on Sunday night. If silver closes Friday at a new all-time high, it sends a signal to China and India that the West has lost control. It invites a massive gap up on Sunday open. The banks know this. They are desperate to paint the tape. They want the weekly chart to look weak. They want a red candle or a long wick to signal exhaustion. They're trying to psychologically manage the sentiment going into the weekend break. But here's the danger for them. By keeping the price artificially suppressed today, by using the margin nuke to hold it down, they're effectively putting a sale sign on silver right before the Asian Open. China sees the margin hike. They know it's a sign of weakness in the Western financial system. Do you think China is scared of a CME margin hike? No. They view it as the West running out of metal and resorting to tricks. So Monday morning becomes a dangerous moment for the shorts. If Asia interprets this move correctly, as a failed attempt to crash the price, they will attack the open. They will buy the liquidity that the West just provided. This is why you never, ever sell physical metal on a Friday pullback. You're selling into a manipulated dip right before the real market has a chance to respond. You're giving away your position to the very people trying to scare you. Now let me show you what's happening in the shadows. Why didn't the price crash today? If the speculators were forced to sell because of the margin hike, who bought their contracts? Usually, when speculators sell in a panic, the price free falls until it finds a bottom. But today, every time the price dipped to 63.50, it bounced right back to 64. It's like hitting a concrete floor. That floor is what I call the shadow order book. In the stock market, you can see level 2 data showing buy and sell orders. But in the physical commodities market, the real trades happen over the counter. They happen in private phone calls between massive corporations and bullion banks. Here's what's happening right now that you can't see on any screen. Corporate procurement managers at companies like Samsung, First Solar, and Tesla have standing orders. These are automated instructions given to their bullion banks. They look like this. If silver drops below $64, buy 1 million ounces immediately. If silver drops below $63, buy 2 million ounces. Why do they have these orders? Because they are terrified of the price going to $100. They see the dip today not as a crash, but as a discount. They know the fundamental shortage is real. So when the CME raises margins and forces the paper speculators to sell, the industrial giants are sitting there saying, "Thank you. We will take that." This is a transfer of ownership from weak hands to strong hands. A speculator buys silver to sell it next week for a profit. Samsung buys silver to melt it into a circuit board forever. Once Samsung buys it, that silver never comes back to the market. It's gone. It's consumed. This is why the floor keeps rising. The float, the amount of silver available for trading, is shrinking every time there's a dip. The banks are accidentally helping the industry drain the vaults faster by creating these artificial dips. They're allowing the whales to accumulate cheaper metal. When you look at that chart and see it refusing to break down below 63.50, you are seeing the strength of the industrial bid. It is an inelastic wall of demand that simply swallows paper manipulation. You're not fighting this alone. You're on the same side as some of the smartest money in the world. So the margin nuke failed. What does the exchange do next? They're running out of options, and this is where it gets dangerous. If raising margins doesn't stop the price rise, And if supply is truly halted, the regulators have only two cards left to play. Card number one is position limits. They will announce that no single entity can hold more than X number of contracts. They'll frame this as preventing market corners, but the real target will be the ETFs and the family offices that are hoarding metal. They'll force them to sell down their positions. This creates forced selling pressure. Card number two is liquidation only mode. This is the nuclear winter option. They can declare that for the next 30 days, you are only allowed to sell contracts. You cannot buy new ones. This effectively turns off the buy button. If nobody can buy, the price can only go down or sideways. If they do this, the paper price will crash. It might go to $50. It might go to $40 on paper. But here's the catch. If they turn off the buy button on the COMEX, the buyers don't disappear. They just move. They move to the Shanghai Gold Exchange. They move to the London over-the-counter market. They move to the physical dealer network. This will cause what I call the great decoupling to accelerate. You will see COMEX silver trading at $40 because nobody can buy, and you will see physical silver trading at $90 because everybody wants it. The spread will be $50. This destroys the COMEX. If the COMEX price is 40 and real silver is 90, no miner will sell to the COMEX. Why would they? They'll sell to Shanghai for 90. The COMEX vaults will drain to absolute zero in weeks. The exchange will become a zombie market trading paper ghosts with no metal backing them. So the regulators are trapped. If they leave the market alone, the price goes to 100. If they manipulate it too hard, they destroy the exchange and lose control of the global price entirely. They're damned if they do, damned if they don't. This is why today's failure of the margin nuke is so critical. It shows they are losing the ability to influence the market without blowing up their own casino. Let's step back from the charts for a minute and talk about why you're here. Why are you holding silver? Are you holding it to make more dollars, or are you holding it because you know the dollar is broken? Today's action, the manipulation, the margin hikes, the volatility, it's all noise. It's the sound of a dying system thrashing around trying to maintain control. The physical truth hasn't changed. Number one, the geology. We are running out of mineable silver. Ore grades at existing mines are falling. Number two, the energy transition. We cannot build the solar panels, electric vehicles, and modern electronics that the future demands without silver. Number three, the debt crisis. The global financial system is mathematically insolvent. They have to print more money. They have no choice. When you hold physical silver in your hand, you hold a claim on the Earth's resources. When you hold a paper contract, you hold a claim on a bankrupt system. The events of the last 24 hours are proof that the paper system is detaching from reality. The paper system is trying to say silver is risky, you should sell. The physical reality is saying silver is essential, you should buy. You have to decide which reality you live in. If you live in the paper reality, you're scared today. If you live in the physical reality, you're buying today. The margin nuke was a test. It was a test of your conviction. Did you panic? Did you sell? Or did you look at the price drop and recognize it as a discount on real money? The banks are betting that you're weak. They're betting that you're impatient. They're betting that you will trade your hard asset for their paper promises. Do not give them the satisfaction. You're not a victim in this system. You're opting out of it. Every ounce of physical silver you hold is a vote of no confidence in their rigged game. They can change margin requirements all they want. They can manipulate paper prices. They can play all the games they want on their casino floor. But they can't print silver. And they can't take what you hold in your hand. That's your power. That's what they're afraid of. So what happens on Monday? Let me make a prediction based on the data. The margin nuke failed to crash the price. The dip was bought up by industrial whales. Short sellers who added to their positions today are now trapped. They are holding shorts at 63.50. The price is already at 64.09. They're already underwater. Over the weekend, the physical shortage stories will spread. The news about halted refineries will hit the mainstream. People will try to buy silver online and realize they can't get it at spot price. Panic will build for 48 hours while the markets are closed. When the Asian markets open on Sunday night and when the U.S. markets open on Monday morning, there will be a rush to get back in. The shorts will panic cover. The sideline money will chase. I believe we will see a gap up on Monday. We could open at $65 or $66. If we do, it leaves the shorts trapped below with no way to exit without driving the price even higher. This bear trap today was the necessary setup for the next explosive move. It shook out the weak hands. It consolidated the price. And it proved the floor is solid. The path to $70 and then $80 is clearing. The banks fired their best shot, and they missed. Today is Friday, December 12th, 2025. We survived the margin nuke. We survived the empire striking back. If you're holding physical silver, go into this weekend with peace of mind. You own the asset that the world needs and cannot print. You own the asset that the banks are terrified of. Do not let the volatility of the electronic pricing system disturb your sleep. 1 ounce is still 1 ounce, and that ounce is becoming more valuable by the day, regardless of what the CME computer says. The game has changed. The old rules where they could crash the price at will are gone. The new rule is physical scarcity, and in a world of scarcity, whoever holds the metal makes the rules. You are not just surviving this system, you are positioning yourself to thrive when it finally breaks. The conviction you show today when the price is being manipulated down is what separates you from the people who will panic buy at $80. You understand what's happening. You see through the smoke. That understanding is worth more than any short-term price movement. Stay stacked, stay strong, and it'll see you on the other side of the gap. If this video helped, you understand what's really happening behind the curtain, hit that subscribe button, drop a comment, and let me know, are you buying this dip or waiting to see what Monday brings? Because next week, we're going to talk about what happens when the COMEX finally breaks. And trust me, you're going to want to be prepared for that.